Go.
Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and today is Thursday, August 7th, as we're recording this. It is a 1:27 p.m. Pacific time, and so you know that this is another episode of Investment Friday for release on Friday, August 8th, to put a timestamp on it. And if you're watching on YouTube, you'll see that Brad and I are like physically in the same space. So Brad is here in Arizona. I'm here in Arizona. And we're in my office. How you
Well,
doing, Brad?
good. She calls it her office, but it's really a brand new production studio that she is designing where she is producing her own podcasts and things like that. So Investment Friday is one of those podcasts.
There we go. Exactly. So, Brad, we have had such a crazy week. Like truly, this has been a little bit like of a wild week. Not necessarily in the markets. It doesn't seem like the markets have responded super strongly to the news, but it's something we really have to talk about because in the next month, in the next 2 months, 3 months, we're not really sure what the data is going to look like because President Trump fired the commissioner of the Bureau of Labor Statistics. Is that
Correct.
correct?
BLS. Yep.
The BLS. So let's dive in right there. Like, what's going on? Why does this matter? And then we're going to talk about market update, what's going on this week. But then also, like, what is the BLS? Why does this matter? How do those numbers come out? How do they get revised? All of that.
Yeah. Just to set the stage, the Bureau of Labor Statistics is the government agency that's responsible for collecting all data regarding payrolls, jobs, unemployment, and the like. That is their job. So there is on the staff of the BLS, there are a lot of economists and data scientists that collect, analyze, clean, and present the results for private payroll growth, job layoffs, job firings, job hirings, all of those things that we rely on to gauge how the economy is doing, the BLS is very, very responsible for. So what happened was last week, the private payrolls number was announced, and there was a big negative to it. It was negative 157,000 jobs. That was a big miss compared to what everybody expected. Now, this also corresponds to March, April, and May also had big negative revisions.
Mhm.
So if you add up all of those 4 months, it is essentially 401,000 jobs that really didn't exist, but are now taken out of the data. And what it does is it shows that the US labor market is weakening, is continuing to weaken relative to what the expectation was. So President Trump took that opportunity to say, you're doing a bad job. These revisions should not be as large as they are. Clearly, there's something wrong with your process. So, therefore, as the leader of this agency, you are going to take the fall. And so he fired that individual on, I believe, Friday. Um, so let's look at private payrolls. Let's look at this data set that really ended someone's at least job at the BLS. Private payrolls are essentially a very boring um, data series that a lot of economists use. Typically, it's just mundane. It's how many hirings and firings are going on in the private sector, meaning private businesses. Um, and why do they have revisions? Okay. What happens is, for example, they'll go through a month, and because companies pay at different times and in different ways, the first preliminary estimate is always incomplete.
Mhm.
So they estimate, let's say in July, they'll announce June's preliminary estimate. Okay. Then in August, as they get more complete data, then they revise it for the first time. And then a month later, they again revise it the second time. That second revision is the final revision, and then it is kind of set in stone. That is the most accurate number we have from all of the data collection, cleaning, and processing and seasonally adjusting. So it's all there. It's a tight number. And so those revisions are typically pretty mundane. On average, it can be 50,000 jobs a month on average. In fact, that is what we call the mean absolute deviation.
Hmm.
All right. So it's basically that's what the average will be. So that's like 600,000 jobs per year. So it's a big number. It's a lot of revisions. Um, in a typical year, you'll have about that average deviation around 50,000 jobs per month. Um, However, in a more volatile or a crazy year where something is changing the economy, for example, COVID in 2020, if you look at, okay, well, 2020 was a pretty crazy year. How did that impact that mean absolute revision? Well, it went from 50,000 to 130,000
Oh, wow.
as a mean average or a mean absolute revision. So it's a big jump, two and a half times. Right now, in terms of 2025, we're kind of right on terms for average,
Hmm.
maybe a little elevated, but not really that significant. Because even in a typical year, you can have months that are about 100,000 jobs off or on. And so it's not unusual. Now, given 2025, what are some of the uncertainties that have been introduced this year
Right.
that may have caused private businesses to delay hiring,
Yep.
cancel job openings, the like? Well, the tariffs are obviously the most televised cause is because the United States and the Trump administration is trying to rewrite the trade rules for the entire globe because we are clearly the largest economy in the world and we have one of the highest lifestyles. And so we're in a very, very important part of the global economy. And so as we try to rewrite those rules, there's uncertainty that's introduced. When that uncertainty is introduced, business owners, business managers tend to be more conservative in their hiring and a little more aggressive in their firing. And so that often can lead to many, many revisions or bigger revisions than a typical year.
Well, and one of the other ways that I heard it explained that made sense to my brain as well with like why revisions happen in the first place is that when they send out, let's say they send out 100,000 business surveys
Mhm.
and 100,000 household surveys, that first number, all 100,000 of each of those groups are not going to get their survey back in immediately. Right. And so you mentioned that too, like all the businesses don't necessarily pay exactly the same way. All of those numbers take time to get in. But the first number posted is that first wave of surveys that are received back. And then the next revision is because, okay, so maybe that first wave, they got 30,000 surveys back. And the second wave, they got another 20,000 back. And the third wave, right? So they get more data as we get, the months go on. And then we get that better picture
Mhm.
of what's actually happening in the economy. And the other aspect that I heard that was helpful to understand as well, and it actually gets into the second topic that I wanted to cover, which is that a lot of the bigger investment banks are now saying like the recession risk has elevated a lot, partially based on these revised numbers, um, and that in recessionary times, this has been a forecaster. If the revisions come in consecutively lower and then lower again, and each month is the revisions are down, that does tend to be a predictor of recession, one of the factors at least, where on the flip side, when we get revisions that are on the plus side, and then you get another revision on the plus side, that is an indicator that we're coming out, right? That the economy is growing again. So all of that put together, right? I mean, that's clearly not the story that the administration wants to tell or to the picture they want to paint is that, oh, like these are recessionary flags that we're kind of waving right now. So from that perspective, well, and then we can go into, the point of, yeah, if jobs losses are up, right? Okay, maybe now it's time to reduce interest rates, right? So there are all these different nuances, but
Yeah.
let's talk about recession and interest rates.
Okay, perfect. So the recession, it does increase the probability of a recession. But right now, what I want to remind everybody is that the labor market is weakening, but from an extremely, extremely strong level, right? I mean, the JOLT survey, which is essentially the number of jobs available in the workforce or in the country um, per unemployed. So it's the JOLTS divided by the number of people unemployed, is around one. So there's
Mm,
one job for every unemployed person. So that's still very, very strong. And it's higher than the long-term average of about zero point 0.7.
okay.
So it's still weakening, but it's still in a pretty decent area. So if if we're going to go into a recession, um, then that is going to probably weaken much further, and you're going to see more people. Right now, I think businesses are very afraid because they went through COVID and trying to find a good qualified worker that would work for the pay you're looking for after, right in that 2020 to 2023 period uh, was really difficult for a lot of businesses. So once they hired those individuals, they're really, really reticent to let them go,
Mhm.
even if we go into a recession. So I think that you're seeing this delay. I think a lot of businesses are pausing hiring and pausing firing decisions a little bit uh, to see where the tariffs end up for their specific business. Um, you know, there are decisions to be made, though. I was talking to a president of a company who has a sister company in Canada where they produce a lot of goods and they sell and service in the United States. And so far, they've eaten all of the tariffs
Mhm.
that have been applied to them. But at a certain point, they can't do that any further, and they're going to have to start raising prices. And so, what do you do? Do you offset those higher tariff costs through reducing headcount, or do you raise your prices, or you do a combination of those two? That's what they're struggling with in that business, and I'm sure that they're not alone. That's multiplied by many millions across the country.
Yeah, and I can't remember if this might have been the week before last week. It was talking about Jay Powell's comments at the last meeting, the last Fed meeting. He was mentioning that the tariff revenue has been about $30 billion per month.
Yeah, that's
Um,
about right.
and so again, that's that cost right now that is being eaten by a good number of businesses. And there are some places where we're already seeing the tariffs filter through into the consumer market. It looks like consumer spending is softening
Mhm.
as well. So yeah, what does that look like from your
So it'll be
perspective?
interesting because right now, as you know, August through end of December is what I call the season of spend, right? It is
Mhm.
where a lot of families spend a lot of money on goods and services, mostly goods, because of, you have back to school, you have the holidays, you have the end of the year New Year's Eve party, and that kind of ends, and we go into the spending doldrums in January.
Yeah.
Um, but this is the season to spend. So I'm very curious to see how retail spending and consumer spending is going to hold up going into, August and September to see if households are pulling back a lot more than we expect. And if they are, that is going to be a real problem for the US economy. Um, However, I think there is something on the horizon which will offset some of that, and that is lower interest rates.
And what is what's the expectation now? Because as of last week or the week before, again, right after the Fed meeting, right, the prediction that we'll get lower rates in September had kind of dropped a little bit to less than 50%. But what's that looking like
It's
now?
back. It's back. Right now, the average expectation is we're going to get three 25 basis point or a quarter of a percent interest rate cuts, three meetings in a row. Okay.
Okay.
So between now and the end of December, you're going to basically take 0.75% off of the interest rate, and it's going to drop by that much. Now, does it happen like a quarter of a point every meeting, or does it happen half a point and then a quarter point in December? We don't know that. Right now, it is on average a quarter point per meeting. But that is the base case scenarios right now being priced in the market is they're going to have to cut kind of aggressively and quickly to keep the U.S. economy in a soft landing, if you will. So that remains to be seen. But with the revisions in the payroll data, coupled with a couple of other data points that have come in a little weaker, you could see that kind of coalescing into the case that rates should be cut.
And what about, so this hits straight into the Fed mandates that are a little bit opposing also, right? Because if job numbers are coming down and softening, but inflation is potentially, we're potentially going to actually feel that more as in the consumer side in the next month or so. Then we've got that teeter-totter, right? Where it's unbalanced, where inflation is going up. So that means we wouldn't reduce interest rates because we want to keep inflation down. But then the job market softening, is the other indicator that's like, we should bring them down a little bit to make room mostly for businesses, right? So that they can tap into those credit lines at a lower interest rate and be able to have access to capital.
Yeah, that's a great question. It is a very difficult mandate that the Fed has to maintain full employment and to maintain price stability. So one of the things I think that is going on in the discussions of the Federal Open Market Committee, which is the committee of individuals who vote and they control the interest rate policy for the United States. Essentially, I think the conversations going on is, yes, we're going to get a near-term bump in consumer price inflation, right? And it's estimated anywhere from 0.5% to 1.5% additional inflation over the next 12 months. But it is a one-time, 1 year, 12-month event. After that, it's kind of already baked in. So the inflation rate beyond that actually drops very, very quickly. So I think the Federal Open Market Committee and their analysis has to consider that this is a short-term event from the tariff perspective. And they have to start looking at, okay, what do we need to do to maintain price stability somewhat, and then really full employment. Right now, we're pretty close to full employment. I mean, with one job being open for every one person who's unemployed, that's as full employment as you kind of get. So I think that is fine unless we start to see a dramatic weakening in that labor market. That will be a bigger difference. I think right now the interest rate policy is mildly tight. So it is somewhat tight. They probably have some room to drop some interest rates without really spiking inflation. So we'll see what they end up doing.
And from a investment perspective, what are we looking at, especially at Juncture? What are we looking at for investment policy going forward? Internationals and emerging markets are kind of like on my radar at this moment right now. Yeah. So what's the forecast going forward?
Yeah, so the forecast, let me start with the equity markets. One of the things you mentioned earlier in the broadcast here is the fact that the equity market is pretty close to its all-time high.
Right.
And it really hasn't seemed like the poor data from the payrolls, some of the other tariffs that are being applied that are almost as a punishment for certain policies that other countries haven't necessarily created the type of volatility that it did back in April. And you're absolutely correct. One of the reasons is because the investor realizes that lower interest rates are coming down the pike. And that is a very important thing for keeping corporate profits elevated. right? If you can lower your interest cost, that drops right to your bottom line and it increases your profits, which increases your equity price, your stock price. Similar with bonds. Similar with bonds. Bonds are been pretty steady, not too crazy on the volatility side either. And part of that is because lower interest rates are in the offing, and they are expecting lower short-term interest rates, and you can see that steeper yield curve coming in. Um, Now, what happens to the long end of the curve is really the question, and we'll find out over the next couple of months as interest rates come down, and yet we see that little bit of increase of inflation. How does that price out in the 10 to 20-year corporate and government bond yield curves? Um, from an emerging market and international space, if we lower interest rates, it should increase the US. It should decrease the demand for the US dollar.
Mm,
So the US dollar potentially could drop further. It's already down to 8 or 9% year to date, which is a big drop, by the way. I
yeah.
mean, that's kind of big. All right. And but if we lower interest rates, what happens? Investors go, well, I can get, 3.5 to 4% in really short-term interest in the US dollar, or I can go to Europe or the UK and put my cash in there and earn a higher interest rate and then just convert it back into the US dollar when I need it. And so that's the arbitrage. That's the conversation in a lot of international investors' heads when it comes to the currency. So we should, if we drop interest rates on a relative basis, we should have a little bit of a weaker currency, which adds up to international investments being more highly valued, meaning they go up in price even if nothing else changes, just because the US dollar drops.
Mm.
So my expectation is the US dollar is going to continue to drop a little bit now, but not dramatically. It might drop a little bit, but it's not going to dramatically change. And so international and emerging market investments, there's lots of reasons to get involved in them. Um, and particularly as the US dollar, as the interest rates in the US come down, a lot of those countries have debt that are tied to the US dollar. So as the US dollar drops, it becomes a more favorable environment for those companies and countries.
And with the tariffs in the conversation still, I mean, still a heavy piece of the conversation just in general, here in the US, has that bolstered any of the, international stocks in general? Like what have international equities in particular done over this past year? Has it made a change? Is there a forecast? Because they were lagging. Internationals, especially international large cap, had been lagging for a long time
10, 15 years.
yeah, right, compared to US large cap growth.
Yeah.
To where like if you had a portion of your portfolio in international for a long time, it was like doing nothing compared to, right? Um, US large caps in particular. But is that conversation changing in general or not really yet?
Yeah, so it's interesting because the tariff. So I'm going to set the tariffs aside because U.S. or excuse me, international developed markets and emerging markets have had a phenomenal year to date. Okay, they're crushing every other equity market by far.
Mm.
But the reason is not necessarily because of the tariffs. The tariffs are detracting a little bit from that, but really it's because Europe itself has decided to rearm to offset or to discourage Russia from any further aggression towards Europe.
Mm.
Okay, so we know about the Ukraine, the Russia's illegal invasion of Ukraine, and kind of the disaster that's going on in that country because of the fact that they weren't armed and ready to fight Russia, which is a much larger country, much better financed, much better armed. Um, at least it was at the beginning. It's starting to even out now, but Poland, Germany, the UK, France, Spain, Italy, they've all decided that they need to up their game in terms of how much how large their armies are, how large
Mhm.
their Air Force and navies are, and they are starting to spend money. In fact, Germany changed their constitution to allow them to use debt finance to go ahead and rearm.
Oh, wow.
And so that defense spending, and I know this is a terrible reason for economic growth, but it is a reason.
Right.
A lot of that deficit spending is accretive to economic growth. And that's one thing that the European Union has really struggled with ever since they got together is economic growth because they've had a lot of bureaucracies, they've had a lot of tax differentials, they've had a lot of um, differing policies, and so they just have never gotten on the same page. And so now it seems like a lot of them are on the same page in terms of rearming. That is driving a lot. That is going to drive some economic growth. And so consequently, you've seen a pretty big jump in both of those sectors.
Interesting. So from that, and that it's been shown time and time again since World War II, even, right? Like World War II is what kind of pulled us in the US out of the Great Depression in a lot of ways.
Correct.
Um, just from the sheer amount of jobs that are produced, the money that's spent, pushed into the economy, from wartime spending. Yeah, it's not my favorite reason for economic growth.
No, and it's not because, but I will say it's one, it's necessary because it's national security, right? You're trying to
Right.
take care of your own citizens. But two, it does generate a lot of jobs and a lot of production and a lot of money. And so, you know, does it does it help create better economies in Europe that they're able to really build upon? That's what we're waiting for.
Okay. So from a let's say from a shorter term, like over the next year perspective, what are we really looking at from like the recessionary lens? Or what's your prediction? I would love to hear that. Like, what do you think is going to happen? And then how do we position both kind of for that shorter term thinking, right? Because most recessions, even a longer recession is like 18 to 24 months. That's like the long end, right? Usually they're quite a bit shorter than that. Um, so what would be our short term versus our mid to long term strategy?
So I don't think we're going to go into a recession at this standpoint. I think we're going to have a soft landing, which I think we're in the process of bottoming on at this point. If we get interest rate cuts, that is going to be very, very supportive of economic growth. In addition, we have the artificial intelligence um, innovation trend that is really starting to take hold. You're starting to see other applications for it. For the average consumer, it's the chatbot, right? We see a lot of chatbots, but it now is extending into a lot of different areas, administrative tasks in any company. And so, in fact, at Juncture Strategies, we're beginning to use some artificial intelligence to help our advisors. So that's a great way. That's a great thing, and we have used it in the past. We used some machine learning to help develop some of the investment strategies. So it's an important aspect to understand that labor productivity between now and the 5 years is going to grow significantly around the world, but really specifically in the United States. It's one of the reasons that you've seen the average price to earnings ratio, which is a very popular valuation metric, grow over many, many decades because we can produce far more.
Mhm.
A worker can produce far more today than they could in 1970 in the United States. And so we're beginning just scratching the surface of this this innovation trend in the United States that is going to increase our labor productivity dramatically. Um, and so I'm looking forward to that simply for the selfish reason that I'm going to get a robot that cleans my entire house. All
That's
right.
literally what my husband is so excited about. He's like, we're gonna have a robot. It's gonna fold the laundry and clean the house, and he's gonna make it wear a wig.
Yeah, there you go. I mean, it's it But it's coming, and people weren't, it's really not that far away. I know people are thinking, is this Ruby from from the Jetsons, or no, this is going to be, these are actually going to be employed and be able to be purchased within the next 5 years.
You think that quick?
Yeah, I think that quick. I mean, for a certain point, you could already see the vacuums,
Yeah.
which can already map out your house, vacuum whenever, on any schedule that you give it, and return to recharge itself.
Mhm.
That is a robot in a sense. It's just not as complex as it will be in the next 5 years as artificial intelligence gets focused on that application.
We have with our new pool, we have a lot of trees and a lot of leaves. And my husband did find it's like a Roomba, but for the pool.
Yeah.
Oh
Yep.
my God, it's amazing.
They're
Like it's
fantastic.
really good. So
Yeah. They save lots of time.
if you have a pool with lots of leaves, like truly, like ours, his name is Ricky. He's named.
Well,
He's
you
Ricky
have
the
to name
pool
them.
boy.
Yeah.
Uh, but yes, like googly eyes and everything. He's great. But yeah, I mean, like stuff like that has been around for a little bit. It does seem like it's getting better
Yes.
than
Yes.
it was.
I mean, I'll give you an example. 2 years ago, I went to a restaurant and a waiter came up to me. I ordered, and a few minutes later, a robot delivered my food to me. And that was 2 years ago. That's kind of before the artificial intelligence. Well, guess what? That is all coming about. Pretty soon, our food in any restaurant you go to will be cooked for the most part by some robots. So it's coming, it's interesting, it's going to help at least corporate America. And by corporate America, I mean uh, from one man companies or one woman companies all the way up to, the largest companies on the globe. It is going to allow us to cut costs, to be more productive, to put more profits to the bottom line. And when that happens, equity prices grow in valuation. Now, that is in 5 years. Over the next 12 months, I think that is one trend, but the interest rates, I think, are going to be very supportive to profit. So we might have some volatility in the equity markets between now and then, but I think the profits will be supported pretty nicely by the interest rate cuts that are coming.
And I know, I mean, for us, my family, we just bought a house. Our interest rate was almost 7% with really, really good credit scores, right? It's like 6.99% or something like that. Um, and there are, clients in that exact same boat that really are hoping for that reprieve in interest rates over the next, next summer would be great, right? To actually refinance, get something closer to that, 5% range. Do you think they'll come down that far?
That's a good question. It really, really depends on what happens in the next 4 months with the season of spend. If
Mm,
we have a very solid season of spend, then no, they will not come down that far. I doubt. Um, if if the season of spend turns out to be much weaker and we continue to get cancellations of our defense orders from our international customers and international investors stop showing up to the US Treasury auctions at nearly as much as they have in the past, that could keep um, those long-term rates a little bit more elevated.
mm.
Um, but if we go into, like you said, if you go into like a mild recession or things slow down more further, yeah, they could get down there.
Interesting. Well, is there anything else that we missed from this week? Because I haven't seen you in like 2 weeks. So,
I know. I apologize. I was out of town last week. I was on quote a business trip slash vacation. So I forgot to tell Hannah that I was out. I apologize. That's my fault. Um, so yeah, I mean, a lot of things. There's one of the things that I really want to emphasize. President Trump, like he was in his first term, is kind of a shock jock, if you will. He's kind of the Howard Stern of the political political people right now. I mean, he's
Yes,
a
I do.
shock jock. He likes to shock people all the time. This happened in his first term, and it took 2 years for the equity markets and the bond markets to figure out that he just likes to shock everybody with everything. And about 2 years in, they stopped paying attention to, and his announcements just became kind of noise.
Yeah.
And if you've noticed over the last 6 months, every month that's gone by, the equity and bond markets have reacted less and less to his statements. And right now, it's almost in my estimation that no one it's his announcements are noise.
Mhm.
Um, we're going to focus on how do the fiscal and monetary policies affect companies, and how are companies' revenues doing, how their earnings are doing, and that's really the critical factor for the next 12 to 24 months.
Well, yeah, that's now that you say that, I'd like definitely remember that trend shifting. And I think you're right. Ever since the taco, Trump always chickens out, moniker that came out from Wall Street, really, like that really has been the trading attitude on the street anyway, right? It's like, we'll see. We don't believe that that's really going to have an impact anymore. Um, and then by the same token, things like firing the commissioner of the Bureau of Labor Statistics could have later, if we can't get data that is trustworthy, or if, we lose faith in the data that we're receiving, that could have implications down the road too. But hopefully, right, we get another person in there that is also loyal to the data. One of the jokes I heard that I thought was hilarious for a statistician was that, like, they actually even have it on their website that if you were to ask a Bureau of Labor Statistics employee if the glass is half empty or half full, that they would reply that it's an 8-ounce glass with 4 ounces of water.
Yes.
And that's what it is.
Yep.
Right?
That's right.
They
That's
don't
right.
have an opinion. It's the data is the data. So I think as long as we have someone in that role that replies, well, that's an 8-ounce glass with 4 ounces of water. What else do you want me to say about that?
Yeah, but I'm also going to push back on that a little bit. How's that?
Push.
So I'm going to use inflation data as an example. Um, we have the official consumer price inflation, which is the average urban consumer, what their inflation rate is year over year. We have the personal consumption expenditure index, which is the PCE, which is what the Fed prefers because it considers suburban, rural, and urban consumers
Mm.
and their change and their prices that they're seeing. Um, and there's a lot of criticisms for those processes. I mean, in my mind, they're probably generally pretty good. But you have Truflation, which is a private company that stepped into the void that essentially monitors 14 million price data points on a daily basis and analyzes that inflation as of today. Because we can do big data, because we can do those things. If the new head of the Bureau of Labor Statistics is not true to the data, there will be other companies that step into that area
Mm.
and will make money, and we'll call them out because their data will diverge, or the official data will diverge so much from what these private companies are showing that you'll start questioning the data from the government, which isn't good, but we will still get the investors will and economists will still get the full picture. It's just from a different source.
That's a really good point. And actually, that reminded me, I did have one like little question about the Truflation
Mhm.
numbers. I was curious if they show historic data too.
They do.
And
They
so,
do.
like, will they show like a cumulative
Yep.
from 2020 to today? That would
Yes, in
be
fact, that's because it's about 2020 is where they started.
okay.
So they do an aggregate cumulative US inflation rate. And as probably not a shocker to everybody, it's pretty high,
Hmm.
right? Because of 2021, 22, 23, we were struggling with a very high inflation rate. Now, their data set is actually more volatile than the official statistics because they don't use averaging.
Okay.
Right? They don't take rents from 9 months ago and say, well, that's what it is today. They use rents as of today. So I think it's a more complete data set. I think it's probably a better one to look at as a check on the official statistics. But it is more volatile than the official stats.
Interesting. Okay. Well, we will leave it there for today. Thank you for coming over and being in my little studio for the moment. Next time, hopefully, it'll be even prettier and we'll have it set up even better for in-person recordings. But if you have any questions, as always, feel free to send us a message, send us an email. All of our contact information is down in the show notes. And Brad, thanks for being here.
Thanks for having me.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.